So the next topic that I wanted to cover on part two is variable consideration. Variable consideration. Okay, you can think of this as the bonus compensation, compensation. Okay, so normally, it is if given a contract, it is possible that there is a fixed compensation, okay, the amount that you're entitled to receive at the end of service or at the end of the contract, and then depending on your performance, if you meet the target, you may be entitled to receive a bonus, an additional compensation, again, depending on the outcome, depending on your performance. If you meet or hit the performance target, in addition to the fixed amount of compensation, you may be entitled to receive the bonus. Okay, so this is what we mean by variable consideration. Okay, so some of the examples include royalties. Okay, so if you are doing very well, so the next topic that I want you to cover on part two is this it's called variable. Okay, variable consideration. You can think of this as the bonus compensation. So given a contract, it is possible that you are entitled to fixed amount of compensation in addition to the bonus. Okay. So the next topic that I want to cover on part two is this notion called variable consideration. You can think of this as bonus compensation. So given a contract, there is going to be a fixed amount of compensation that you're entitled to receive, but also it is possible that it comes with a condition. If you meet or hit a performance target, you may be entitled to receive an additional compensation or bonus. Okay, so there are two basically items to consider. One is the fixed amount, the other is the bonus amount. Okay. So the question is, given this variable consideration condition or bonus compensation condition, how do we record the revenue? Okay, so there are two ways to record the revenue with respect to the bonus compensation. One is called the expected value method, and the other is most likely amount method. Okay, so let's take a look at this transaction. So TrueTech enters into a contract with Pro Sport Gaming to add Pro Sports online games to the TriNet network. Okay, so hopefully I added a slide here. So let's take a look at here. For example, TrueTech in this case is going to be the Apple. So Apple provides this gaming platform, right? So game developers plays their games on the Apple's platform, right? So in this case, Pro Sport is going to be Roblox. Okay, so Roblox, the game developer, providing these games on the Apple's platform. Okay. All right, so Pro Sport or Roblox game developer offers popular games like Brawl or Bands, and once those games offered on the Apple's platform or TriNet to sell gems, weapons, health potions, and other games features that allow players to advance more quickly in a game. Okay, the terms of the contracts are on January 1st, Pro Sport, okay, the Roblox pays Apple, okay, an upfront fixed fee of $300,000 for 6 months of featured access. Okay, so this is an upfront fixed fee. ProSport also will pay TrueTech a bonus of $180,000 if TriNet users access Pro Sport Game for at least $15,000 hours during the 6 months period. So depending on the outcome, depending on whether you hit the target or not, you may be entitled to receive an additional compensation bonus of $180,000. TrueTech estimates a 75% chance that it will achieve the usage target and receive the $180,000 bonus. Okay. So there's an upfront fixed fee, $300,000, and then the bonus of $180,000. All right, so okay, let's use first most likely method. Okay, most likely method to record the journal entry. Okay. All right. Under the most likely method, we are going to just follow the scenario or the case with the highest probability. Okay. So in this case, since there is a 75% chance that you are going to receive the bonus, in other words, there's a 25% chance that you will not get the bonus. We're going to just follow that case with the highest probability, the highest likelihood. Okay, so in this case, since 75% chance is above 50%, we are going to assume from the very beginning that we are going to receive the bonus. Okay, all right. So in this case, okay, so not the expected value method. All right. So today I get cash, okay, $300,000 because that is a upfront fixed fee, okay, and then that's deferred revenue, okay, revenue $300,000, okay. So this is a 6 months contract, okay. So initially we record deferred revenue liability, and then we're going to convert that to service revenue for the next 6 months period. So this part pertains to the fixed amount of compensation. And then the second part relates to the bonus. Okay, so we are going to record the journal entry pertaining to the bonus because under the most likely method, we have a above 50% chance. We have a 75% chance that we will get that bonus. Okay. All right. So the amount of bonus that we are going to record is, okay, first, the name of the account is called bonus receivable. Okay, bonus receivable. So just like how we record accounts receivable or notes receivable, the amount that we think that we're going to collect at the end of the contract, the name of the account that we're going to use is called bonus receivable. Okay. And then the credit part is actually, let me stop right here. All right, so let's take a look at this transaction or contract. TrueTech enters into a contract with Pro Sport Gaming to add Pro Sports online games to the TriNet platform. So what is happening here? So let me just quickly help you understand what's going on here. So TrueTech, you can think of it as Apple. Apple is the one, our company providing the platform for users. And then Pro Sport Game, you can think of it as Roblox. So Roblox is a game developer. So Pro Sport is a game developer providing the games on the Apple's platform here. Okay, so TrueTech, Apple, Pro Sport is Roblox, okay, game developer. All right, so the game developer offers, oops, my bad, offers popular games like Brawl or Bands, and once those games offered on the Apple's platform, right? The terms of the contracts are on January 1st, ProSport, okay, Roblox game developer, pays Apple TrueTech an upfront fixed fee of $300,000 for 6 months of featured access. Okay, so I'm gonna pay you $300 upfront fee so that we can have more users play our games on Apple's platform. ProSport also will pay TrueTech a bonus of $180,000 if TriNet users access pro sports games for at least 15,000 hours during the 6 month period. Okay, so depending on the outcome, okay, if you hit the performance target, you may be entitled to receive an additional compensation or bonus of $180,000. Okay, so the fixed compensation, $300,000, bonus compensation, $180,000. TrueTech estimates a 75% chance that it will achieve the usage target and receive the $180,000 bonus. All right, so this is what's going on here. We have a fixed compensation, $300,000, and a bonus compensation of $180,000. Let me draw a timeline. Okay. So this is a 6 month contract. So 1, 2, 3, 4, 5, and 6. Okay. All right. So initially, TrueTech receives an upfront fixed fee. So the journal entry will be debit cash. We receive cash $300,000. And then by receiving prepayment, now we have an obligation to provide the platform for the game developer. So that's deferred revenue, $300,000. Okay. All right. So this is what you record initially at the start of the contract. All right. So 1 month has elapsed. Okay. So at the end of month one, okay, we are going to convert this deferred revenue into service revenue, right? Now we're going to convert only 1/6 of it. Okay. So we first debit deferred revenue 1/6 of $300,000. Okay, so $300,000 over 1/6. Okay, so we get $50,000, and then we convert that into service revenue. Okay, $50,000. Okay, so with respect to the fixed compensation, at the end of the first month, we recognize service revenue of $50,000, 1/6 of the upfront fixed fee. Okay. And then, in addition to the fixed fee, there's a bonus component. Okay. This is where you are going to record a journal entry pertaining to the bonus. Now, first, we are going to use most likely method. Most likely method. Under that method, the way we are going to approach the journal entry is that we are going to follow the case or the scenario that with the highest probability. Okay, so what that means is that here it says the company estimates a 75% chance that it will achieve the bonus, it will achieve the target. In other words, what that means is that there is a 25% chance that we will not achieve the target. Okay, so 75% versus 25%. Under the most likely method, we are going to record the journal entry based on the case with the highest probability. In this case, 75% chance. Okay. In other words, what things we are going to assume that we will get the bonus at the end of service. Okay, so the bonus amount is $180,000. Okay, $180,000. So the name of the account that you want to record is I will collect the bonus. So it's called bonus. Okay, bonus receivable. So just like how we use accounts receivable or notes receivable, the amount that you think that you are going to collect at the end of the contract, we use bonus receivable, the amount of bonus that we think that we are going to collect at the end of the service. And the amount is, so the bonus amount is $180,000, and we are going to only recognize 1/6 of it. Okay, so the amount is $30,000. Okay, And then since this bonus pertains to your service that you're providing, we're going to call it service revenue. Revenue, $30,000. Okay. So the blue journal entry pertains to the fixed compensation. The green part pertains to the bonus compensation using the most likely method. So when you are actually recording the journal entry in the hallmark, right? On the hallmark, you will record. We basically combine these two. So debit deferred revenue, okay, $50,000, and then debit bonus receivable, $30,000, and then credit service revenue, $80,000. So this is the journal entry that you will be recording at the end of the first month. Okay, and this will be another journal entry for at the end of year two, at the end of months 2, 3, 4, 5, and 6. You're going to repeat this journal entry for 6 times individually at the end of each month. Okay. All right. Now, okay. At the end of 6 months, you are going to find out whether you hit the target or not. Okay. So case number one, if you, okay, if you hit the target, then, okay, if you hit the target, then you are going to receive the bonus, right? So the amount of bonus that you receive is going to be debit cash, $180,000. That's the amount of the bonus that we have recognized. Okay, so for example, $30,000 each month times 6 months period, that's a total $180,000. By collecting cash, you remove your receivable. So bonus receivable will be removed. Okay, so $180,000. However, if you find out that you did not meet the target, if you miss, okay, miss the target, okay, then you are not entitled to receive the bonus. I'm not going to collect cash. So what you want to do is first remove your bonus receivable, okay, bonus receivable, and on the debit side, what you are going to record is reduce your service revenue. Okay, we have been recording service revenue assuming that we're going to receive the bonus. Since we're not going to get the bonus, we are going to reduce our service revenue by $180,000. Okay. All right. So these are two possible outcomes. One, I'm hitting the target. We receive the bonus. So we get cash, $180,000. If you miss the target, we remove our bonus receivable that we have been recording the past 6 months. And also we reduce service revenue, $180,000, the same amount. Okay. Now, these are the journal entries that you record using the most likely method. Okay. All right. Now, let's use the expected value, okay, value method. Okay. So we're going to use some statistics to record the journal entry based on the expected value method. Okay. All right. So drawing the same line. Okay. There you go. So first month, second month, third month, fourth month, fifth month, and then the 6 months. So same transaction. Initially, we receive an upfront fixed fee. So that's debit cash. We receive $300,000. And then it's going to be deferred revenue, $300. Okay, we are obligated to provide a platform for the next 6 months period. Okay, so at the end of the first month, okay, after providing the platform to the game developer, we're going to convert this deferred revenue into service revenue. So with respect to the fixed compensation, we debit deferred revenue, only 1/6 of it. Okay, so $300,000 times 1/6. So that's $50,000. Okay, and then we record service revenue, $50,000. Okay, so hopefully this bullet part is not too bad. We've already done this using the most likely method. Let's do the journal entry for the bonus part. Okay, bonus part. Now, just like last time on the debit side, we are going to record bonus receivable. I expect to collect bonus at the end of the service. Okay, but the amount is so the bonus amount is $180,000. However, the chance, the likelihood that we receive the bonus at the end of the service is 75% chance. Okay, so using statistics, what we're going to do is we're going to multiply this by the 75% chance that we're going to collect that bonus. Okay, and then since this is a 6-month period, we're only going to recognize 1/6 of it. Okay, 1/6 of it. Okay, so what's the amount? Okay, so 180,000 times 75% chance, and we're only going to recognize 1/6 of it because this is a 6-month period. Okay, divided by 6. So the amount of bonus receivable that we're going to recognize is going to be 22,500. 500. And that's the amount of service revenue that you are going to recognize, 22,500. Okay. So under the most likely method, okay, using the outcome with the highest probability, the amount of bonus receivable, okay, bonus receivable was $300,000 at the end of the first month because the total amount of bonus was 180,000. However, using the expected value method, using the statistics, we actually multiply the bonus amount, $180,000, by the chance, the percentage that we're going to get the bonus, 75% chance. Okay. All right. So the journal entry that you are going to be recording at the end of the first month is first debit deferred revenue. Okay, the amount was $50,000. And then debit bonus receivable. Okay, it was $22,500. And then credit service revenue. It's $72,500. So this is the journal entry that you record at the end of each month for the next 6 months period. Okay. All right. So we have been recording this journal entry for the past 6 months. Let's see the outcome. Okay. Let's see. Okay. First outcome. If you hit the target, then we're going to get the bonus, right? Hit the target. All right. So we hit the target. We collect the bonus. It is $180,000. So it's debit cash, $180,000. We collect cash. Okay. And then we remove, by collecting cash, we remove bonus receivable. However, the total amount of bonus receivable, that we've recognized so far. Okay, so each month's bonus receivable, 22,500. We record this for 6 times. Okay, so the total amount of bonus receivable that we've recorded the past 6 months is $135,000. So to balance the debit and credit, we will have to plug in an additional $45,000, and that $45,000 will be recorded for service revenue. Okay, we increase our service revenue by an additional $45,000. Okay, so that's the journal entry. If you hit the target and receive $180,000 bonus compensation. Okay. All right. Number 2, if you Meets the target. Meets the target. Meets the target. Then we're not going to get the bonus. So first, we remove the bonus receivable that we have been recording the past 6 months. The total was $135,000. Okay. And then, since we're not going to get the bonus, we reduce service revenue by $135,000. Okay, so this is a journal entry that you record if you miss the target. Okay. All right. All right. So the last topic that I wanted to cover is the change in the estimate. Okay. So what that means is that, let's take a look here. Assume that after 3 months, the company concludes that due to low usage of the games, the most likely outcome is that it will not receive the $180,000 bonus. So previously, we initially expected to receive the bonus with a 75% chance. But however, turns out that we're not going to get the bonus after 3 months. Okay, so the question becomes, once you realize that there is a significant change in the estimate, how we adjust the journal entry. Okay, so under the most likely method. Okay, so let me again draw the timeline. Okay, draw the timeline, 6 month period, 2, 3, 4, 5, 6. So every month, okay, every month under the most likely method, this had been the journal entry. Okay, so deferred revenue $50,000, bonus receivable $30,000, and then service revenue total $80,000. Okay. $80,000. All right. So let me write down here. So at the end of month one, okay, at the end of month one, okay, uh, it will be deferred revenue $50,000 and then bonus receivable $30,000, okay, and then service revenue $80,000, okay. So the next topic that I want to cover on this part is the change in the estimate. Okay, so what's happening here is this. Assume that after 3 months, the company concludes that due to low usage, the most likely outcome is that it will not receive the $180,000 bonus. So previously, we had a pretty good feeling about the bonus. We had a 75% chance that it will get the bonus. But turns out that after 3 months, we now realize that we're not going to be able to collect that $180,000 bonus. So the question becomes, how do we make an adjustment to the journal entry? Okay, given this significant change in the expectation of the for the bonus. Okay, so for this one, why don't I uh, draw a timeline again? Okay, timeline here at the end of first month, second month, third month, fourth month, fifth month, and the 6 months. And under the most, okay, most likely method, the journal entry that we previously recorded was, okay, there you go. It was deferred revenue 50, and then bonus receivable 30, and then service revenue, the sum of 50 and 30, $80,000. So this was the journal entry at the end of each month using the most likely method. So I'm just going to copy the same journal entry here. Okay. All right. So at the end of the first month, we record debit deferred revenue, $50,000. We debit bonus receivable, $30,000, and then credit service revenue, $80,000. Okay, so this is what you're going to record at the end of month two and then at the end of month three. Okay, And then this is where you realize that I'm not going to be able to collect the bonus. Okay, so what you first have to do is to reverse all the journal entries that you have been recording pertaining to the bonus. Okay, so if you take a look at here, at the end of the first month, you recorded bonus 30. At the end of second month and third month, you recorded additional bonuses. Okay, so the total amount of bonus receivable that you have recognized, okay, for the past 3 months becomes $90,000. Okay, so what at that point, what you're going to record is first remove bonus receivable. So we credit bonus receivable total $90,000, and then we reduce service revenue. Okay, service revenue $90,000. Okay, so by recording this journal entry, we are essentially removing all the bonus receivables that we have recorded the past 3 months. Okay, and then going forward, what you are going to record is simply, okay, at the end of month 4, simply deferred revenue, the fixed amount, $50,000, and then service revenue, $50,000. Okay, so we don't record anything pertaining to the bonus receivable because we now realize that we're not going to get that bonus. Okay, so at the end of month 5, at the end of month 6, okay, this is the journal entry that you will be recording, okay, under the most likely method. Similar idea applies to the expected value method. Okay, so let me scroll down. Okay, under the expected value method, okay, same timeline, okay, same timeline, 1, 2, 3, 4, 5, and 6. Okay, so the first month, okay, what was the color? Okay, orange. Okay, at the end of the first month, the journal entry that you record was under the expected value method. This was the journal entry. Fixed amount, deferred revenue 50, bonus receivable with a 75% chance, 22,500, and then credit service revenue, 72,500. Okay, so let me just copy that journal entry. All right, so debit deferred revenue, $50,000, and then bonus receivable, 22,500, and then credit service revenue, 72,500. So this is a journal entry that you record at the end of month 1, month 2, and then month 3. And then that's the point where we realize that we're not going to get the bonus. Okay, so just like last time, we have to reverse the bonus receivable journal entry because we're not going to get the bonus. Okay, so the past 3 months, you have accumulated, let me use the calculator, each month 22,500 times 3, you've accumulated a total of $67,500 of bonus receivable. So we credit bonus receivable 67,500, and then we reduce service revenue, okay, 67,500. Okay. Once we remove that, for the rest of the journal entries, just pertaining to the fixed compensation. So it'll be deferred revenue, $50,000, and then service revenue, 72,500. Oh, not 72, my apologies. Fixed amount, $50,000. So that's what you record at the end of month 4, at the end of month 5, and then at the end of month 6. Okay. All right. So that's everything that I wanted to cover on part 2. Okay, so just to review or recap, the first part focused on the allocation of the transaction price based on the standalone selling price if the contract has multiple performance obligation And then the second topic related to the bonus compensation. We use the most likely method and the expected value method to record the journal entry. Okay. Let's do a couple of exercise questions before we finish the lecture here. All right, so CD enters into a contract offering variable consideration, so bonus compensation. The contract pays CD $2,000 per month for 6 months of continuous consultant services. In addition, there is a 60% chance that the contract will pay an additional $4,000 and a 40% chance the contract will pay an additional $6,000. So the outcome in this case is binary. Either you receive $4,000 bonus or $6,000 bonus. So you're gonna get bonus regardless of outcome. The difference is that the amount. Either you receive 4,000 or 6,000. Okay. Citi concludes that this contract qualifies for revenue recognition over time. We're going to be using the most likely method to record the journal entry. All right, so let's use the most likely method. Most likely method. Okay, let me draw a timeline. So this is a 6 month contract. So 1, 2, 3, 4, 5, 6. Okay. So every month I am getting paid $2,000. So that's 2,000, another 2,000, 2,000, 2,000, 2,000, 2,000. So this is the fixed amount of compensation, okay? And then with respect to bonus, it's either 4,000 or 6,000. Since we are using the most likely method, we are going to just record a journal entry with an outcome of the highest probability. So in this case, we don't even consider this 40%. We only consider this 60% chance outcome, okay? Because it is a higher percentage. What this means is that we're gonna assume that we're gonna get $4,000 bonus at the end of the service because it has a higher percentage of outcome. Okay. All right. So the bonus amount is 4,000. So that's 4,000. Since this is a 6 month contract, each month we record a journal entry 1/6 of $4,000. Okay. So $4,000 divided by 6. So we record bonus receivable of $667. Okay, $667. Okay. All right. So what is the amount of revenue? Okay, so the journal entry, okay, will be first. It will be okay, we get cash. So I'm just gonna assume that actually I'm just gonna use accounts receivable. Okay. So accounts receivable with respect to the fixed compensation, $2,000. And then with respect to bonus receivable, $667. And then the sum of these two will be service revenue, $2,667. So this will be the journal entry. So the answer is B here. Okay. All right. Let's use the expected value method. Okay, expected value method. So expected value method. All right. So same timeline here. Okay. 1, 2, 3, 4, 5, and 6. Each month I get paid fixed compensation $2,000. Okay, $2,000. All right. For the bonus, okay, so we have a binary outcome, 60% chance, $4,000, 40% chance, $6,000. So statistically speaking, the way you calculate the bonus per month is, so bonus amount $4,000 has a 60% chance plus $6,000 with a 40% chance, okay? And then since it's a 6 month contract, we only recognize 1/6 of it. Okay, so the amount is 2,400 plus another 2,400 divided by 6. Okay, all right. So 2,400 plus 2,400 divided by 6. So each month we recognize $800 of bonus receivable. Okay, so the journal entry will be, okay, accounts receivable, fixed compensation 2,000, and then bonus receivable, it was $800. Okay, and then service revenue, the sum, service revenue will be $2,800. Okay, so this will be the journal entry that you record at the end of each month. So choice C is the answer using the expected value method. Okay. All right. So that's the end of the lecture. Part 3 is a continuation of the revenue recognition topic. But for now, thank you so much for tuning in, and I look forward to seeing you on the next lecture.